It's now time to step towards Homes Today. This will be hosted by our famous and beautiful realtor and an advisor at Remax Realty. Her good name is Miss Audrey Forshey. Her guest today is Mr. Barry Filderman, who is a senior loan officer. Today, their focus on screen will be on credit repair and credit issues. Let's have a look.
Hello viewers, welcome to Homes Today. My name is Audrey Forshey from Remax Realty Services in Rockville, Maryland. Again, I have Mr. Barry Filderman from George Mason Mortgage, who's in the Rockville, Bethesda area and does mortgage loans for consumers. Today we've talked about different kinds of loans, and so today what we're going to do is talk about credit scores. You've heard Barry say in the past that a lot of the pricing and a lot of the things that go with your mortgage these days is based on your credit score. So we're going to talk about good credit scores, if you maybe have not such a great credit score, or maybe you had a short sale in your past or something of that nature, and what it means to you if you want to get back out in the market to purchase a home, and maybe some of the things that you need to watch out for or some of the things you need to do now. So Barry, hi.
Hello.
So let's talk about the ranges of the credit score. So great credit is what number? B, like I guess they call it A, B, and C credit. Do they still call it that?
Well, they used to call it that.
Okay, so what are the ranges?
The BC stuff really isn't there anymore, but the credit ranges, anything over 800 is exemplary. Not many people have over 800 scores.
Okay.
Anything above 760 is really where you're going to get the best price.
Okay.
So even if you have 800 scores, it's the same.
So the best price means the best interest rate that you can find.
Best interest rate, best mortgage insurance, best everything.
Okay, all right. Okay.
Once you start getting down to under the 760, it's 740 to 760, 720 to 740, 700 to 720. And as you drop those 20 points, it affects the pricing, it affects the mortgage insurance, it affects what you can do and what you can't do.
That's so interesting, because back in the old days, if you had 680 or above, that was like really good credit. So now you got to go all the way to 760 to have a really good credit, right?
Yeah, well, back in the old days, there didn't used to be credit scoring at all.
Yeah,
that was my day.
That's true. That's
but
true.
Yeah, 680 used to be a good score, and it is with an FHA loan. And again, we get back to making sure you put your customer in the right product.
Okay.
But most people are not 760. Most people have had issues. Most people might have had a loss of a job. They have a medical situation. They have a bankruptcy, a judgment, a collection. And you need to know what to do in these scenarios, and you need to know what program to go into. And it's so important because they're all different. I've seen people, they try to shove you into a program and they just don't qualify for it. So you got to know if you have that short sale, the foreclosure, you got to have, if you have a judgment, if you have payment plans, a tax lien, all these scenarios are usually workable as long as you meet the parameters of the program. I'll give you an example. FHA, for instance, will have a 3-year issue if you have a foreclosure or a short sale. It's 3 years.
Even for a foreclosure?
Even for a foreclosure. Bankruptcy, FHA is 2 years.
Okay.
On a conventional loan, bankruptcies are 4 years.
Okay.
And so are the foreclosures. They're 4 years.
Okay.
But unless and there's always an exception to the rules, and you got to know the questions to ask the customer to see if you meet these exceptions. Anything that's a medical problem or a loss of job, or you can document that you can show one W-2 and the next year is significantly lower, that's an exception. FHA will go to a year on those type of exceptions. My personal opinion, those are the only 2 exceptions.
So they'll go to making someone wait a year with the credit scores. That's what you're saying. They'll go
if you
only
have
go 1
an
year back.
extenuating circumstance beyond your control. Now, conventional used to be where if you put 20% down, it was 2 years. But now they changed that into no matter how much you put down, they will do 2 years, but you have to have that extenuating circumstance.
Okay.
The problem is, though, is if that bankruptcy or foreclosure hurt your credit score and you're going 5% down, you might not get a computerized approval. You might qualify for the program, but if you don't get that DU approval, which is desktop underwriting, that's Fannie Mae's underwriting engine, or LP, which is Freddie Mac's. What good is it? This is why you need to know you can go to that FHA program that will allow a much lower credit score and not hit you so much for the interest rates and so forth. But there are many issues. You could have medical collections, and a lot of people don't realize that those don't have to be paid off. They're not only that, but they're going to eliminate the medical collection in the credit scoring.
Oh, really?
Yes. Now, the thing that I like to do is if I'm looking at someone's credit and I see that they're at a 655, and I know I can get them a better rate at 660 or 680, or I can do better for them on mortgage insurance, I can see things on that credit report that we can do to make the scores go up.
So what are those kinds of things? I mean, so let me ask you this too, sorry to interrupt you, but so let's just say that, you know, people have things on their credit that they don't even know that are on their credit. I bet you find that a lot, that
Yes.
you'll pull someone's credit and you'll say you have this medical collection, let's say, on your credit report, and they don't even know that that's on there. Then you've got to work to fix that and do whatever you've got to do, the advice that you're going to give them. So I guess that's another reason why it's so important when you're going out to buy a home, you need to sit down with a loan officer first, have your credit pulled, and figure out what loan program you're going to do first so you can find these sorts of things. Is that
Yes.
correct? Yeah.
And this just happened yesterday. I had a customer that had the same scenario you're talking about. I never heard of that. I don't know what that is. I never paid that late. And I always tell the customer, call. You never know. Some people say that 40% of all credit reports are wrong or incorrect
really?
in some fashion. So the customer called and it was a mistake, and now we're getting it removed. Well, if you have a late payment in the last 12 months, that could be 50, 60 points. And a lot of loan officers will kind of deal with what they have, and I really like to try to fix things if I can and make it better if I can. The thing that drives the credit scores mostly are credit card balances. And here's something, yes, you definitely don't want to max out your credit cards, but a lot of times somebody will have two $500 credit cards and they'll owe $490 on each credit card. Well, the credit bureau looks at it as percentage of credit available to you.
Okay.
If you take $800 and pay those things down to $10 or to $100, you could, it's the same thing if you have a $10,000 credit card and you pay it down to $9,000. So it's percentages. So you could get a huge increase in your credit scores just by paying down
And your
a
credit
card.
cards.
You want to try to keep them under 25%, but if you're at max, anything that's under 50 will help your score. And if you're 5 points away from getting a better price, then why not take the extra time and try to make it better and give the customer a better rate?
That'll save you a lot of money over the long haul for sure.
It
won't
does.
It
It
Yeah.
does.
So, so if I have a low credit score, and let's just say that somebody had a short sale, and so I want to come back into the market and buy a house. Tell me what my rules are for coming back into buying a house if I had a short sale.
Well, short sales are treated just like foreclosures.
Oh, they are? Okay.
Now, a lot of times, and I've had about 4 of them, sometimes if someone's moving from California to here and they can't afford it, they'll do a short sale, and there never was late payments on that short sale.
Right.
If there are no late payments on the short sale, FHA doesn't count it as a short sale. You don't have to wait. So a lot of people don't know that.
That's all. I have always learned that, or thought that that was the case. You had
Yes.
to wait.
No, not if you don't. If you don't have late payments, you don't. If you do have late payments, it's treated like a foreclosure.
Okay.
So again, FHA is 3 years and conventional is 4. But here's something that people don't know: is that conventional has changed when it comes to foreclosures.
Okay.
The way it used to work was a foreclosure would say someone had a bankruptcy and they put their house in a foreclosure in the bankruptcy. They discharged it. And as you know, it took 2 years before the bank actually foreclosed. The clock starts when it forecloses.
Oh.
So your 4 years or 3 years, whatever it is, could start 2 years after your discharge of a bankruptcy, and people realize they didn't qualify for the loan.
Oh, I see.
But conventional just changed where they will go off the discharge date, which I think all of them should, but unfortunately FHA does not. FHA goes off the actual foreclosure.
I see.
But conventionally now you can do a loan that may have been foreclosed 6 months ago, but as long as in your bankruptcy, back when 4 years where you're eligible to purchase a home.
So if I'm coming back into the market after having a short sale or some sort of a credit issue, FHA is probably going to be my best bet in terms of getting back into the market.
In most
to buy a home.
most situations, yes, unless you're in that situation where your bankruptcy is 4 years old, the loan is in the bankruptcy, but it didn't foreclose until a year ago. Conventional would be a better bet there.
All right. So, and then things that can be out of your control. So let's say hypothetically you're married, and unfortunately some people, I guess, go through divorces and stuff like that. My spouse, what if I'm married and I'm going through a divorce and I have an irresponsible spouse? What they do will reflect on me. Is that right? In taxes, their taxes, and does that make a big mess?
It does in most cases, but in some situations it doesn't, and let me explain. If your ex vindictively doesn't pay credit cards and you guys are getting into arguments and you both aren't paying because your lawyers tell you not to pay, that is not an excuse. It even says in the guidelines, divorce is not an excuse.
Oh, really?
It says it right there. That's not a circumstance beyond the control of the borrower. Except if you have a divorce agreement or a separation agreement that puts the responsibility of the house in the husband's name or the wife's name, they messed up.
Oh,
and you have
good.
a court order saying it was their responsibility, we do not hold that against the customer.
Oh, that's very good.
If it affects your score, though,
Oh,
as long as you qualify with whatever score you have, we're not going to hold that against it if we have a written agreement.
so you can't use that divorce separation agreement to increase the score,
No.
is what you're saying. So you're already going to have a fairly good score if there are some dings on
Well,
the
if you have a
credit.
short sale,
Yeah.
and that responsibility was your husband's, and you're trying to buy a house, and you have that on your credit report, we're not going to count that short sale against you.
But so how can we get the score up then?
Well, you
How do we
can't
do
for that.
Okay.
But hopefully your score will be in the mid-sixes and we can put you into something. And a lot of
Okay.
times after years, you know, the model of the credit scoring, it's mostly 24 months. So as long as the stuff is old and it's over the 24 months, your scores could be pretty good after a bankruptcy.
Okay. And then I know that if I have people that come to see me sometimes, and if they're first-time home buyers, maybe they have student loans on their credit
Student
scores.
loans have all changed.
Okay, so
Student
what
loans,
happens
it
with
used to
them?
be if your student loan was deferred, then and it's more than 12 months, we didn't have to count the debt, and that's changed. Then it went to we had to count 2% of the balance, and that was a disaster. Now they're back to 1%. Some programs are whatever is on the credit report, because sometimes it's less than 1%, whichever's higher. So even if you have a low payment on your credit report, you still have to use the 1%. So it depends on which program you're going to about student loans. So deferring student loans is a thing of the past, except on VA loans, they still allow student loan. But let me bring up judgments and collections.
Okay.
Here's something that most people don't know, is that FHA has changed. They actually had the book for 30 years, and just recently it's changed. If you have a collection on an FHA loan and it's $10,000, $15,000, they now allow you to take 5% of that balance as a payment, and if you qualify with that payment, you don't have to pay off the collection.
Really?
Yes, and that's completely different than a conventional loan. So when I tell you, please sit down with a loan officer, let's
Yes.
look at all this. There's just because someone says no doesn't mean it's no. A lot of people don't know these new rules, so you gotta really go with a professional person. Normally, your real estate agent knows which people get loans through and which not. So people that sometimes go to the internet and they shop, if you hear a no, don't give up.
So yeah, don't give up. And so if I have, or as I remember, the student loans used to be that you used to have a signed agreement that you had a monthly payment plan with them, that you had to agree to pay so much back to student loans if people defaulted on them. So is that still the same way?
Well, if you have a payment plan, you have to qualify with the debt. And you probably want at least 6 months of paying that back. But you're talking collections that you have a payment plan on. Now, a lot of people also realize if you have a tax lien, as long as you're on a payment plan for, I think it's 3 months for FHA. It used to be nothing, as long as you're on a payment plan. As long as you counted the debt against them and they qualify with that, you didn't have an issue. These are all things that come up on people's credit, and a good loan officer will steer you to the product that will most likely fit that particular customer.
And kind of what I guess we're saying is that not that you want to have judgments or tax liens and stuff to be going to purchase a property, but that sometimes you have your credit pulled and you're ready to buy a house because you have to move. These are some of the ways that you can deal with it with an experienced loan officer. So again, Barry, thank you for all your good advice. You always help us out. I really appreciate it. Thank you very much.